Just something that can be liquidated very quickly.
Okay. And if you liquidate a CD, you know you're going to incur a penalty. You won't get the. Have you been happy with the rates that you're getting on those CDs?
Oh no, of course not.
Okay. Let me ask you another question. The $40,000 that you have in mutual funds, have you been satisfied with the performance that they have incurred over the last few years?
No.
All right. Well, now, I don't know if you realize this or not, Glenn, but there are ways to position your money to where you can share in stock market gains without any risk. Zero loss possibility. Now, I know we're here to talk about mortgage protection first and foremost, but we do an absolutely phenomenal job helping people protect their hard-earned retirement dollars and yet still give them decent returns. So if you'd like some free information on how you can participate in stock market gains with zero loss, I'll be glad to make a note here and bring back some additional information at a later date. Is that fair
Sure,
enough?
that'd be good.
Okay, great. Let me make a note here. Okay, great. All right. Now, you've got 40 plus 5 plus 5, that's $50,000 in assets. So we can subtract that, so we're down to $495,000. Now, Glenn, that $495,000, that's a bottom line need of your insurance. And that number is only as good as these numbers up here that you gave me. So are these numbers reasonable and not excessive up here?
Yeah, the only thing I think we can play with is what I want to leave to the grandkids on the college fund, but everything else is very reasonable.
Okay, now let's be as conservative as we can, because the higher the number down here, obviously the more need, and the more need, then the more expense for that need. So let's be as conservative as we can here. Do we need to subtract some from the $6,000 per month, or do you need to subtract some from the $25,000 per child?
Actually, right now, I'd like to stick with what we have.
Okay, great. I mean, sometimes it is what it is, right?
It is what it is.
Now, let me tell you this, that hardly anybody I sit with, Glenn, takes care of all this at one fell swoop for budgetary reasons or for whatever, okay? But if they had one area, one priority number one place they like to focus first and foremost, it's typically the mortgage, because they don't want to lose the home if something happens to one or the other one of them.
Right.
And despite all the hoopla you hear about mortgage crisis and real estate crisis that we're in today, one of the chief reasons that people still lose their home is the death of one or the other breadwinners. The one left behind, Glenn, is put under such a tremendous financial strain that they often end up losing their house. I know you don't want that to happen. So let me ask you, is the mortgage of $300,000, is that really what you'd like to focus in on today?
That would be my minimum focus, yes.
Okay, great. So if we can take care of the $300,000 number for the mortgage protection today, then that obviously would be a big step in the right direction for your total insurance needs, right?
Absolutely.
Okay, great. So we'll focus in on the $300,000 today, and again, we can always add additional coverage at a later date. Okay? Now, any questions on that process?
No, sounds good.
Okay, good. Well, you definitely have a need. So now let's look at the Hartford program, okay? Now, this is an exact copy of the letter that you got from Hartford, all right? The first thing I want you to understand about this, Glenn, this information is free to you. There is no cost, no obligation to you. Like many of our existing policyholders, though, once you see how well thought out this plan is, I feel sure you're going to love it. Now, when I get through the presentation, Glenn, I'll explain everything to you crystal clearly. About the only thing we'll have left to do is really look at the various plan choices that are available to you. That way you can pick one that meets your budget, and you won't have to think about it, and you can make a yes or no decision at that point. After all, Glenn, Hartford requires me to see 20 people a week, just like yourself. If every one of them had to think about it, I never would get around to seeing everybody. Is that fair enough?
That's fair.
Okay, great, great. Now, the letter goes over to address 3 key benefits here. Number one, obviously, if you die, the mortgage can be paid off, free and clear. So the house is owned, there's no debt, right? Number 2 is an excellent savings feature, where if you live and you ultimately pay off the mortgage yourself, then Hartford is going to give you back every single dime that you put into the product over 30 years.
Okay.
So that's an excellent tax-deferred savings vehicle, just like an IRA, just like a 401k, okay? Now, one major difference though, and we'll touch on that in just a second, but you understand what that really means. All the money back. That's like living in this house for 30 years, making that mortgage payment every single month, and at the end of the 360th payment, Glenn, you finally got that house paid off. Hallelujah, right? The house is owned free and clear. The next day, the mortgage company comes knocking, gives you a check. Glenn says, here, Glenn, there's a check for every dollar that you spent with us over the last 30 years. That wouldn't be a bad retirement program, would it?
No.
Now, you'd have to pay taxes on that, most likely, right? Well, that's exactly the kind of program that Hartford says right here. After 30 years, they're going to return every single dollar back to you, with one big notable exception. All these dollars can be accessed, if structured properly, tax-free. No taxes. Unlike your IRA, unlike your 401k, where taxes are paid, zero taxes. Do you realize how valuable that could be in 20 or 30 years?
Be valuable.
You realize that the tax rate, let me ask you something, you think the tax rate's going to go up, down, or remain the same over the next 20, 30 years?
Going to go up.
I think so too. In my humble opinion, I think we're both right. Tax rate is going to rise dramatically. Social Security, health costs, national debt, it could easily double or triple what the maximum tax rate is now. That's 40%, right? So every tax-free dollar that we could get 30 years from now could be the equivalent of 3 or 4 or even 5 taxable dollars, right?
Right.
Okay, so that's a very important feature. Now, number 3 is an add-on feature, all right? You got to qualify for the mortgage protection, but this is a great feature that will pay your mortgage for you if you become disabled, unable to do your job, okay? Any questions on the features and benefits?
Not right now.
Now, before I get too involved in the presentation, I know you're probably familiar with Hartford, right? Probably heard something about us. Let me give you our 30-second TV commercial on the Hartford. That's a stag. That ain't Bambi. That ain't a deer, okay? That's a stag, right? Don't ask me what a stag is, but that's a stag, right? Now, this year, 2010 will be our 200th year in business. We started way back in 1810, Glenn. That's about the time that Napoleon was running around making Europe unsafe for most folks, right? So common sense has got to tell you that if you're around for 200 years, you've got to be doing something right. Wouldn't you agree?
I agree.
Okay. 1856, good old Abe Lincoln himself actually bought a policy from us. How about that? 16th
Wow.
President of the United States. Wouldn't you like to have been that Hartford agent, huh? 1929, I make mention of that only because if we remember our history books, that's when the stock market crashed and the Great Depression started, right? Well, I mention that because Hartford actually came out stronger than ever, because Hartford, Glenn, does not invest in stocks primarily, but bonds. And bonds are 100% guaranteed. In fact, just 3 short years later, Glenn, in the middle of the worst depression this country has ever had, soup lines out the gazoo, people out of jobs, Hartford had enough financial strength to help finance the construction of the Hoover Dam outside of Las Vegas and the Golden Gate Bridge in San Francisco. 2 of the most unbelievable engineering marvels of all time, helped to finance by Hartford dollars. Now, you've got to have some deep pockets to do that in the middle of the Great Depression, don't you?
You do.
Now, let's bring us up to more current times. 2001, we probably all still remember where we were when the towers fell, right? The 9/11 tragedy. Well, Glenn, 7 days after that tragedy, Hartford paid out $850 million in claims. Now, you may not be aware of this, but sometimes it can take months to process a death claim. 7 days after the 9/11, that's before they even had all the dead bodies exempt. Hartford pays out almost $1 billion. Glenn, that's the kind of company I want to do business with. So I said all that to say this. We've been around for a long, long, long time, haven't we? And when we had to pay up, paid up pretty daggone promptly. So Glenn, I don't think you have to worry about your $300,000. Do you?
No.
Okay, let's put that aside. Now, let's talk interest rates here for a second. Interest rates are important because 3% represents what the pace of inflation has averaged over 20 plus years. Now, what is inflation? What does inflation mean? What happens to prices?
They go up.
They go up, yeah. That means everything gets more expensive, right? So if inflation has averaged over 3% for the last 20 plus years, why is that important? Well, you like me probably have a few dollars in checking, right? Last time I looked at my checking account, I think I was earning less than 1%. Checking accounts don't earn a whole lot because they're very liquid, right? My point being, Glenn, if I'm making 1% on my check and on my money, and inflation is running at 3%, and I'm not making any money, I'm falling further and further behind, aren't I?
Right.
See? And that's important because Hartford guarantees 3% tax deferred and pays a current 4.5% tax deferred rate. Right? Now, what do I mean by current and guaranteed? Well, this is a floating rate. The current rate of 4.5% is a floating rate. These policies are backed by bonds, and bonds are 100% guaranteed, Glenn. So if the bonds go up, this floating rate can go up to whatever the prevailing rate is, 6, 8, 10% or more. And it can fall. But if it falls, Glenn, it can never fall below what?
3%.
3%, because why? That's your what?
Guaranteed rate.
Guaranteed rate, that's exactly right. And 3%, Glenn, will meet the pace of inflation over the last 20 plus years.
But what part of my money is going to gain 4.5%?
Part of the money that you put in as a premium. We'll talk about that a little bit later, okay? Hold that question. But 4.5%, Glenn, if you look in the papers the last weekend, what CDs are going for? What are CDs going for these days?
2.
2.25 maybe, right? Taxable, Glenn, taxable. Meaning you're going to pay taxes on that, so you really don't get 2.25%, do you?
Right.
Here, this is tax deferred. No taxes taken out of this, just like your IRA or 401k. Pretty valuable thing to have, isn't it? Okay. Now, a lot of times people will ask me about this time, Jamie, that's all well and good, but is this money guaranteed? All right. Now, you're probably familiar with the FDIC, Federal Deposit Insurance Corporation. If a bank goes belly up, the FDIC steps in and makes that client whole, right? Well, there are 2,000 insurance companies in America. They're part of something called the Legal Reserve System. It's been around since 1807. Never been a problem, because it requires insurance companies to maintain 85% asset to liability ratio. So insurance company gets in trouble, the legal reserve system steps in, protects those clients. So with the legal reserve system backing the bonds and the bonds backing the returns, this becomes a no-lose situation for you, doesn't it?
Yes.
Okay. Now, number 2 benefit, flexibility, is probably one of the most important benefits that we have. This is a living, breathing program for you. It's not a stick in the mud, unchangeable, can't change anything type of situation, okay? Flexibility is important because why? You've probably been around long enough to realize that what? Life changes, right?
Exactly.
Things don't always remain the same, do they?
No.
Okay? Right now you need $300,000 to pay off your mortgage. Wouldn't it be nice though if you move into a bigger house or need more coverage to simply call up Hartford and say, Hartford, I'd like additional coverage. We can add coverage right on top of this kind of program. Wouldn't that be nice? You don't have to go outside and buy a brand new program or a brand new policy. You can simply add coverage to this existing policy. Okay? Now, what if the opposite happens? And all of a sudden, you get into a budget bind, and now you can't afford the premiums to maintain this policy. Hartford knows that most people are going to have to let that policy lapse, right? They don't want that to happen. This is valuable, permanent coverage, right? So, you call up to Hartford and say, hey, I'm in a budget bind. I need to reduce, lower my premiums, maybe even skip a premium or 2. Now, Glenn, you can't do that forever. But for 3, 4, 5, 6 months, you can lower the premium, skip a premium or 2, and still maintain that valuable $300,000 life insurance amount. Wouldn't that be important? Okay. Now, what I also have, Glenn, some people, doctors, professionals, executives, who dump additional money into this kind of product. They add to their premiums. Why do you think they do that, Glenn?
I would assume it has something to do with that 4.5%.
Exactly. Very sharp, astute observation on your part, Mr. Glenn, because they know how valuable tax-free dollars will be, and they know that that 4.5% is a very strong rate in today's economy, tax deferred especially, right? So you can vary the premiums up or down depending on whose financial goals and objectives.
Mine.
Yours, exactly. And you can vary the coverage up or down, again depending on whose financial goals and objectives.
Mine.
Yours. So you are in complete control. This kind of program or product will change and adapt with your needs, your goals, your objectives. Do you see how valuable those could be?
I do.
You don't get those kind of valuable options and flexibility with term or whole life.